Pause for a second and ask yourself one uncomfortable question. What if the financial advice you've been hearing your whole life was never meant to make you rich? Not because it's completely wrong, but because it's only true for a different level of the game. You were told to work hard, save consistently, diversify your investments. It sounds smart. It sounds safe. But if that path really worked, why do most people stay in the same financial position for their entire lives? Here's the truth no one says out loud. There are two sets of rules. One is public, easy to follow, easy to accept, designed for the masses. The other one is never talked about on TV. That second set of rules is what the truly wealthy quietly use every single day. And today, you're about to see it. Don't leave yet, because what you hear in the next few minutes might change your life from this moment on. Rule 1. Inversion: stop trying to be smart. Start avoiding stupid. Most people approach money the wrong way. They ask, how do I get rich? They look for the next big stock, the next hot trend, the next breakthrough idea. It sounds logical, but in reality, it's a trap. Because the more you chase being right, the more chances you create to be catastrophically wrong. Now here's the shift. Billionaire investors flip the question. Instead of asking, how do I win? They ask, how do I make sure I don't lose? This is called inversion thinking, and it's brutally practical. Let's look at the math. If you lose 50% of your money, you don't need 50% to recover, you need 100%. If you lose 80%, you need 400% just to break even. And if you lose 90%, you need 900% to get back to where you started. That's not investing anymore. That's survival. This is why avoiding big mistakes is far more powerful than chasing big wins. Now let's ground this in a real example. During the dot-com bubble, late 1990s, millions of investors rushed into internet stocks. Many of these companies had no profits, no real business model, sky-high valuations. But people didn't care. They were chasing 100% returns. Then reality hit. From 2000 to 2002, the NASDAQ index lost about 78% of its value. Thousands of companies disappeared. Trillions of dollars were wiped out. The people who were trying to be smart were the ones who got destroyed. Meanwhile, investors who simply avoided what they didn't understand survived. And in the long game of compounding, survival is everything. Here's the uncomfortable truth. You don't need to find the next apple. You just need to avoid the next disaster. That means don't invest in what you don't understand. Don't chase hype. Don't use excessive leverage. Don't let emotions control your decisions, because most financial failure doesn't come from bad luck. It comes from preventable mistakes. So the real question isn't, how do I get rich fast? The real question is, what are the few things that could completely destroy me, and how do I avoid them at all costs? Do that consistently over time, and you won't just survive the game. You'll eventually win it. What is one financial mistake you've made or almost made that could have seriously set you back, and what did it teach you? Rule 2. Radical concentration: bet big when you're right. Most people are taught to play it safe, diversify, spread your money across many investments, never put all your eggs in one basket. It sounds responsible, but here's the uncomfortable truth. Diversification protects you from ignorance, but it also dilutes your upside. Now let's look at this from the mindset of George Soros, one of the most aggressive and successful investors in history. Soros didn't build his fortune by being average across 50 ideas. He built it by going all in when he had high conviction. His most famous trade? In 1992, he bet against the British pound. He didn't invest 5% of his portfolio. He didn't test the waters. He made a massive concentrated bet, reportedly over $10 billion. In a single day, he made about $1 billion in profit. Why was he willing to go that big? Because he followed a simple principle. It's not whether you're right or wrong, it's how much you make when you're right, and how much you lose when you're wrong. This is radical concentration, not reckless gambling, but asymmetric conviction. Here's how you apply this in real life. First, wait longer than everyone else. Most people jump into opportunities too early. Soros waited until the imbalance was obvious when the risk-reward ratio was clearly in his favor. Second, build a deep understanding before acting. You don't concentrate on random ideas. You concentrate on what you truly understand: economics, a business, a market pattern. If you can't explain it simply, you shouldn't bet on it heavily. Third, scale your bets based on conviction. Most people treat all decisions equally. Soros did the opposite. Low conviction, small or no position. Medium conviction, moderate exposure. High conviction, aggressive concentration. Fourth, cut losses quickly, without ego. Even Soros is wrong often, but when he's wrong, he exits fast. This is critical. Radical concentration only works if your downside is controlled, because concentration without discipline becomes destruction. And finally, ignore the noise. When you concentrate your capital into a few ideas, people will say you're reckless. They'll tell you to be safe. They'll question your decisions, but understand this: no one becomes extraordinarily wealthy by making average decisions. Wealth is created when you see something others don't. You act when others hesitate us, and you go big when the odds are in your favor. So the goal is not to always be active. The goal is to be selectively aggressive. Wait patiently, study deeply, act decisively, because in this game, you don't need 100 good decisions. You need a few that you're willing to back everything. If you had to choose just one opportunity today to go all in on, what would it be? And more importantly, do you truly understand it well enough to deserve that level of confidence? Keep watching, because the next idea might be the most important one in this entire video. Rule 3, inner scorecard: think independently, even when it feels uncomfortable. Most people don't realize this, but their financial decisions are not really their own. They are shaped by news headlines, social media, friends, neighbors, co-workers, and the constant pressure to not look stupid. This is called living by the outer scorecard, where your decisions are judged by how others see you. Now here's the problem. If you invest based on what feels socially acceptable, you will almost always be late. This is where George Soros was fundamentally different. Soros didn't care about consensus. He cared about reality. His entire investment philosophy was built on one idea: markets are often wrong and driven by human bias, which means to win, you must be willing to stand alone. Let's look at a real example. In the early 1990s, most investors believed the British pound was stable within the European exchange rate mechanism. Governments supported it. Institutions trusted it. The majority agreed. This is safe. But Soros saw something different. He believed the currency was fundamentally overvalued and that the system holding it up was unsustainable. Now think about the psychological pressure. He was going against central banks, against governments, against the global consensus. If he was wrong, he wouldn't just lose money. He would look foolish on a global scale. But Soros didn't care about looking wrong. He only cared about being right. So he trusted his analysis and took the position anyway. What happened next? In September 1992, the UK was forced to withdraw from the system. The pound collapsed, and Soros made about $1 billion in a single day. This is the power of the inner scorecard. Now here's the deeper insight. Soros was not always right. In fact, he has openly admitted that he is wrong many times. But that's not the point. His advantage was this. When he believed he was right, he acted boldly. When he realized he was wrong, he changed quickly. No ego. No need to defend his reputation. No attachment to being seen as smart. Because his decisions were not tied to how others judged him. They were tied to his own internal standard of truth, and this is extremely rare. Most investors hold losing positions to avoid admitting mistakes, follow trends to avoid standing out, chase hype to feel included. Soros did the opposite. He embraced discomfort. He accepted isolation. He prioritized correctness over approval. Here's what this means for you. If you want to apply the inner scorecard in real life, make decisions based on facts, not opinions. Be willing to look wrong in the short term. Detach your identity from your investments. Change your mind quickly when the data changes, because in the market, popularity does not equal truth, and consensus does not equal safety. Sometimes the moment you feel the most alone is the moment you are closest to being right. Have you ever had a moment where you knew something didn't feel right but still followed the crowd anyway? What happened, and what did you learn from it? Rule 4. The art of doing nothing, mastering the power of patience. In today's world, being busy is seen as a virtue. People feel productive when they are constantly trading, checking prices, reacting to news, making decisions every day. But in reality, this constant activity is often the fastest way to destroy wealth. Because in investing, action is not where money is made. Patience is. Let's look at real moments in history where doing nothing was not laziness, but a strategic advantage. First, the 2008 global financial crisis. Markets collapsed. The S&P 500 dropped about 57% from its peak. Fear was everywhere. Banks were failing. Headlines were screaming, "The system is broken." Most investors panicked. They sold it at the bottom to protect what was left. But those who did one simple thing, nothing, and held quality assets, saw something very different. From 2009 onward, the market began one of the longest bull runs in history. Over the next decade, the S&P 500 grew more than 4x. The difference between losing and winning was not intelligence. It was the ability to sit still under pressure. Now look at another moment, the COVID-19 crash in 2020. In just a few weeks, global markets dropped over 30%. Uncertainty was extreme. Entire countries were shutting down. Businesses were closing overnight. No one knew what would happen next. Again, panic selling surged, but within months, markets rebounded sharply. By the end of 2021, many indices had reached new all-time highs. Those who kept trading emotionally missed the recovery. Those who stayed calm benefited from it. Now let's go further back. The dot-com bubble burst, 2000-2002. After years of hype, tech stocks collapsed. The Nasdaq fell nearly 78%. Many investors tried to time the market, jumping in and out, trying to recover losses, but the constant switching only locked in damage. Meanwhile, long-term investors who avoided overtrading and waited for fundamentally strong companies eventually saw the next wave of growth. Companies like Amazon that went on to dominate. Here's the pattern across all these events. The crowd reacts quickly, emotions spike, activity increases, and yet the biggest returns came to those who could resist the urge to act. This is the paradox. Doing nothing feels like you're falling behind, but in reality, you are preserving your position for when it truly matters. Because every unnecessary action adds transaction costs, increases taxes, introduces emotional errors, and most importantly, it interrupts the compounding process. Think of investing like planting a tree. You don't dig it up every week to check if it's growing. You let time do the work. But here's the hard part. Doing nothing is not passive. It requires emotional control, confidence in your strategy, the ability to ignore noise, and the discipline to wait, sometimes for years. Most people fail not because they lack knowledge, but because they cannot sit still. So the real skill is not predicting the future. It's controlling your behavior in the present. Wait longer, act less, choose carefully, because in this game, the less you move when nothing matters, the more powerful you become when something finally does. When was the last time you made a financial decision out of fear or urgency, and looking back now, would doing nothing have actually been the better move? But all of the above will be useless if you don't understand the next rule. Stay with me. We'll explore this rule now. Rule 5. Ruthless subtraction discipline is choosing what to destroy. Let's be clear about something most people don't want to hear. You are not failing because you lack opportunities. You are failing because you refuse to eliminate them. Your time is limited. Your energy is limited. Your attention is fragile, and yet you keep saying yes. Yes to side projects. Yes to maybe investments. Yes to ideas that feel exciting but are not exceptional. This is not ambition. This is a lack of discipline, because in the real game of wealth, success is not built by adding more. It is built by cutting aggressively. Here is the rule. If it is not clearly one of your top priorities, it is a distraction, not neutral, not harmless. A distraction, and distractions compound just like money, except they compound into failure. Look at your financial life right now. How many things are you doing that feels productive, but are they not truly moving you forward? Checking random investment ideas, chasing small, inconsistent returns, splitting your focus across too many directions. These are not just minor inefficiencies. They are silent killers of progress, because every hour you spend on something decent is an hour stolen from something great. This is why ruthless subtraction exists. You must train yourself to say, no, not now, not this, even when it feels uncomfortable, even when it feels like you're missing out, especially then, because the most dangerous opportunities are not the bad ones. They are the good ones that are not great. They look attractive. They promise quick wins. They give you the illusion of progress, but they drain your focus until you have nothing left for what truly matters. Here is what discipline looks like in practice. You define your top 5 financial priorities. You eliminate everything else that competes with them. You refuse to split your capital across weak ideas. You stop chasing just okay returns. You protect your time like it is your most valuable asset. And most importantly, you accept the cost of missing out, because you will miss things. You will watch others make money in areas you ignore. And you must be okay with that. If you are not willing to feel that discomfort, you will never reach depth in anything. Focus requires sacrifice. Real focus requires you to kill options you like. Let that sink in. Not the options you hate, the ones you like, because those are the ones that will tempt you the most. This is where most people break. They hesitate. They keep doors open. They balance too many paths. And in doing so, they guarantee mediocrity. You cannot win that way. So here is your standard. If it does not clearly serve your main objective, cut it. If it divides your attention, cut it. If it drains your energy without meaningful return, cut it. No hesitation, no negotiation, because every great outcome in finance is built on concentrated effort over time, and concentration is impossible without elimination. This is not about being harsh. This is about being honest. You don't need more options. You need fewer, better ones. And the moment you start removing everything unnecessary, your progress will stop being slow. It will become inevitable. What is one good but not great financial habit, investment, or commitment you know you need to cut right now, but haven't had the discipline to eliminate yet? Rule 6. Reputation leverage. Trust is the fastest currency in the world. Let's get one thing straight. In the highest levels of finance, money is not the ultimate advantage. Trust is, because when trust is high, everything else becomes faster, cheaper, and bigger. And when trust is broken, everything collapses, no matter how smart you are. Now let's look at this through the lens of George Soros. Soros was not just known for making bold bets. He was known for something far more valuable: credibility. Throughout his career managing the Quantum Fund, he attracted billions of dollars from investors around the world. Why? Not because he was always right, but because people trusted how he operated. They trusted that he would act decisively. He would cut losses quickly. He would not hide from reality. And most importantly, he would be transparent about risk. This trust became a form of leverage, because when investors trust you, they give you something more powerful than money. They give you freedom to act. Let's take a real situation. During periods of high volatility, like currency crises or market shocks, most fund managers face pressure. Investors panic, they withdraw capital, they question every decision. But Soros often had the ability to move quickly without being paralyzed by that pressure. Why? Because his reputation was already established. Investors understood his strategy. They accepted that short-term losses were part of long-term asymmetric gains. That level of trust allowed him to take bold positions when others were stuck defending themselves. Now here's the flip side, because reputation is not always positive. Soros also experienced what happens when reputation becomes controversial. After his famous 1992 trade against the British pound, he was labeled by some as the man who broke the Bank of England. Governments criticized him. The media attacked him. His name became polarizing. This is important because it shows a deeper truth. Reputation is not about being liked. It is about being consistent and understood. Even when people disagreed with him, they knew one thing. Soros would act based on his convictions, not politics, not emotions, not public pressure, and that consistency made him predictable in the only way that matters in business. He could be trusted to be himself. Now bring this back to your level. You may not be managing billions, but the principle is exactly the same. Your reputation determines who is willing to work with you, who trusts your decisions, who brings opportunities to you. If people trust you, deals happen faster, negotiations become easier, opportunities come to you without chasing. If people don't trust you, everything becomes friction. Everything becomes slow. Everything becomes expensive. Here's the discipline this rule demands. Do what you say every time. Be honest, especially when it costs you. Admit mistakes quickly. Never trade short-term gain for long-term credibility. Because once trust is damaged, it doesn't just reduce your opportunities. It multiplies resistance in everything you do. And in a world where most people cut corners, integrity becomes rare. And rare things carry premium value. So understand this clearly. Reputation is not a moral idea. It is a financial strategy. It lowers costs. It increases speed. It attracts capital. And over time, it becomes a silent force that works for you in rooms you are not even in. If someone had to decide whether to trust you with a serious financial opportunity today, what past actions of yours would they use as proof, and would that evidence actually be strong enough? The final rule that follows isn't a breakthrough rule, but it will help you control your own greed. It will make you more insightful and confident in your decisions. Rule 7. Know the sucker stay in the game you can actually win. There's a hard truth in finance that most people avoid. If you don't know who the sucker is in a deal, it's probably you. That may sound harsh, but it's also incredibly empowering once you understand it correctly, because this rule is not about fear, it's about clarity. And no one embodied this better than George Soros. Despite being one of the greatest investors of all time, Soros never believed he could win in every field. He didn't try to understand everything. He didn't chase every trend. He didn't pretend to have an edge where he didn't. Instead, he focused on one simple question: where do I actually have an advantage? And just as important, where do I not? This is what separates confidence from arrogance. Most people think confidence means saying, I can figure anything out. But real confidence sounds like this: I know exactly where I'm strong and I refuse to play where I'm weak. Let's make this practical. Every market, every investment, every opportunity is a game. And in every game, there are players with different levels of skill, information, and experience. If you step into a game where others know more than you, others move faster than you, others have deeper insight than you, then you are not investing. You are donating. This is why so many people lose money chasing trends, jumping into crypto without understanding it, trading stocks based on headlines, following hot tips from social media. They are not playing their own game. They are stepping into someone else's arena where they have no edge. And the market is ruthless to people like that. Now here's the shift. You don't need to win everywhere. You don't need to understand everything. You don't need to chase every opportunity. You only need to find a small circle where you are not the sucker. Maybe it's a specific industry you understand deeply, a type of business you've studied for years, a strategy that fits your personality and discipline. Your circle can be small. That's not a weakness. That's your territory. And inside that territory, you can be unbeatable. Because when you stay within your circle, your decisions become clearer. Your confidence becomes grounded. Your risk becomes controlled. You stop guessing. You start knowing. This is where true power comes from. And here's the most important part. Walking away is a strength. When you see an opportunity you don't understand, you don't chase it. You don't feel pressured. You don't feel left behind. You simply say, good for them, not for me. That sentence alone will save you years of financial pain. Because the goal is not to prove you're smart. The goal is to stay in the game long enough to win. So trust yourself, but do it intelligently. Trust your preparation. Trust your understanding. Trust your limits. Because the moment you respect your boundaries, you stop being the sucker. And when you stop being the sucker, you finally start playing the game on your terms. What is one area where you truly understand the game and one area where you honestly know you don't, but might still be tempted to step in anyway. We've just walked through 7 rules, not the kind you hear on TV, but the kind that quietly shape how real wealth is built. And if there's one thing you should take away from all of this, it's not a strategy, it's a shift in mindset. You don't need to be the smartest person in the room. You don't need to chase every opportunity. You don't need to move fast, look impressive, or prove anything to anyone. What you need is clarity. Clarity to know what to avoid. Clarity to focus on what truly matters. Clarity to trust your own thinking, even when it goes against the crowd. Because in the end, financial success is not about doing more. It's about making fewer, better decisions and having the discipline to stick with them. You've seen it now. Avoiding big mistakes is more powerful than chasing big wins. A few focused bets can outweigh a lifetime of scattered effort. Patience often beats constant action, and self-awareness will protect you more than any hot tip ever could. This is not an easy path. It requires you to be patient when others are rushing, to stay calm when others are panicking, to stand alone when others are seeking approval. But if you can do that, you gain something most people never will: control. Control over your decisions, control over your risks, and ultimately, control over your financial future. So don't walk away from this video and go back to the same habits. Pick one rule, just one, and start applying it today, because wealth is not built in one moment. It's built in quiet decisions, repeated over time. Stay patient, stay disciplined, stay aware, and most importantly, trust yourself enough to play the long game. Thank you for watching.